For nearly 30 years, Nvidia's chips have been coveted by gamers, shaping what's possible in graphics and dominating the entire market since it first popularized the term graphics processing unit with the GeForce 256. Now, its chips are powering something entirely different.
ChatGPT has started a very intense conversation.
He thinks it's the most revolutionary thing since the iPhone.
Venture capital interest in AI startups has skyrocketed.
All of us working in this field have been optimistic that at some point the broader world would understand the importance of this technology. And it's actually really exciting that that's starting to happen.
As the engine behind large language models like ChatGPT, Nvidia is finally reaping rewards for its investment in AI.
Welcome to Personal Finance Cat, where I share my personal take on personal finance. All right, today we're going to talk about Nvidia stock. Man, this company has been doing so well. Many people are talking about it. It just seems like came out of nowhere and then all of a sudden, boom. If you look at the lifetime performance of this stock for a long time, from 1999, since it first became public, to 2016 or 17, very slow. And then all of a sudden, boom, you see this hockey stick growth. Why? I think the reason is pretty obvious. I did a video a year or so ago talking about the top Metaverse stocks to buy, and this is one of them because there's such growth in cryptocurrency, in Metaverse, and now AI. Nvidia is really a picks and shovels play, no matter which company wins in either Metaverse or cryptocurrency, if those industries still manage to grow going forward. And AI, which is almost a definite at this point, Nvidia is going to win as well because they'll need to buy chips or GPUs, as you will learn in a little bit from their business description. Very excited about this stock. Is there still an opportunity? Because the price is really high now. So clearly there are differing opinions. Some people think this is a top short pick. Some people think that the share still looks cheap. So who is right? Who is wrong? We'll see. Let's dive right in. Okay, first off, let's start with the qualitative side of the business. I really like how clean their 10K looks, and it's a fairly easy read to go through their business description. Again, it's just very clear that the growing tech companies will need Nvidia because they have this highly sought after product called GPU. I listened to the latest earnings call and I was very, very impressed by Janssen Huang. I didn't know too much about the company other than the fact that he's a self-made man. He immigrated from Taiwan as a young child. He started this company with some co-founders. But when he speaks, the clarity and the simplicity just really blew my mind. People asked a lot of pretty technical questions, but he was able to answer all of them, which shows how familiar he is with the business. And he could also explain it in such a easy to understand fashion. I really love it. And I have to say, he really pumps up the company. If you only listen to his speech without looking at the numbers, I was almost going to jump right in. So one of the things he said is, what is GPU? He said, people think it's just a box, but there are thousands of components in the GPU. That's why it's so difficult to make. It has such strong performance. Just seems like all these companies that are growing, like Microsoft, like ChatGPT, like Tesla, they all need GPUs. One of the things they did touch upon is the R&D spend. They do spend a lot of money in R&D. I'm not too concerned about that. I think a company does need to invest heavily in R&D to continue to be competitive. Even for this industry, there's a lot of competition. I really didn't see any red flag looking at the company's business profile and listening to the quarterly earnings call. Simply stated, there are two segments of the company. One is the computer and networking segment, and the other is the graphics segment. But as you see here, there are really just a lot of use cases of their products and services. The other thing that he mentioned why he believes there is still such a strong growth is because AI is going to be ingrained in every company now, not just OpenAI, ChatGPT, because a lot of large companies wouldn't feel safe to hand over their confidential information to these other companies to generate AI capabilities. So what do? They have to develop their own AI capabilities. What that means is that they all have to go to Nvidia and ask their help to develop something for them specifically. So then they don't have to hand over their data to somebody else. In other words, they're using Nvidia as a contractor to build something from scratch. If you work for a large company, chances are you probably heard that your company is developing some AI tool that's specific to your company. I definitely believe that this is going to have even more growth as more and more companies realize and decide to develop their own AI tools. As you can see, their markets also have a lot of promising areas that they cover: data center, gaming, professional visualization, and automotive. And we all know that the automotive is Tesla, and I'm sure there will be more companies coming on board developing self-driving cars and such, which will also need to use NVIDIA's offerings. Again, like I said, a very promising company. Let's take a look at the quantitative analysis. This company has become a $1 trillion company just over the last couple of years, maybe even just 2 years, which is amazing. So similar to what I usually do, I look at 4 valuation methods just to complete the picture. Unfortunately, all of them indicate that it's overvalued, which is not surprising. I tend to use very, very conservative assumptions. As you will see, if I play around a little bit in at least one of the options, it would turn a different recommendation. But because as value investors, we really want to be conservative, that is the result I'm showing. But let's go into each one individually. First method, discounted cash flow. First step, we have to figure out the return on equity. Why? Because we as shareholders provided the equity. We want to see how much return the company is generating for the equity. A couple of simple steps, but ultimately we're trying to get at equity per share by dividing the total shareholder equity with the shares outstanding. And then with the earnings per share, we get to the return on equity, which is earnings divided by equity. This company does provide dividend. They give some of that earnings to shareholders as dividends, and then whatever is retained is called retained earnings. Why is that important? Because that's the money you can keep in the company so that it continues to generate more profit for you. Going to the forecast part, what I'm trying to do here is we have the equity per share for this latest quarter. They have a weird year end, even though it's only 2023, it's already considered their Q3 2024 because they have a January year end. So January 2023 was already considered the end of their fiscal year 2023. So their latest quarter, quarter 3 2024, the equity per share is $13.47 as we calculated here. And then their earnings per share is $4, dividends 16 cents. They will retain $3.86. What I'm doing here is to project the equity per share going forward. The idea is that you either grow this equity at this average equity growth rate, or you add the retained earning, whichever is smaller, again, to be conservative. So in this case, it happens to be if we use the average equity growth rate. Next step is what's the earnings per share projected? That's easy. You just multiply the equity per share by the average return on equity. Dividend, we just use the assumption that it's the same dividend yield based on most recent dividend payout. And then lastly, retained earning is the difference between earnings per share and dividends. So we do this for the next 10 years until we get to the end of the projected period. That would give us an earnings per share of $18.51. So that's your future earnings per share. And we need a future PE ratio. This came from Seeking Alpha to get to the future price in 10 years. PE ratio, if you don't know what that means, it's the multiple. Whatever your earnings is, the multiple of that is what the stock price is. As you can see here, in 10 years, we're projecting the stock price to be $718.63. And what we do is we discount it back, assuming a 20% annual return to get to this price that we would buy at. Meaning if price is at this level or lower, we buy because it will give us a 20% return or higher. As you can see, it's not nearly as much as the current stock price, but like I said earlier, I'm being very conservative. Even Seeking Alpha, their average return on equity is much higher than the 24% that I have here. They have something like 60+%. I don't know how they got their numbers. To be honest, I don't think that's unreasonable because if you look at just the last couple of years, it's growing steadily, very fast. The 12-month trailing average, we're looking at almost double of the revenue from the prior year. And it's not just revenue. They keep their bottom line too. The operating profit is more than 3 times last year's. So again, like I said, this is a very promising company. It's growing like crazy. The question is, how sustainable is this growth? That's why we use average ratios to be conservative. Anyway, that is my recommendation to sell based on this discounted cash flow model. But let's say if the average return on equity is 60% instead. It's getting closer. It's a watch recommendation. And if the PE ratio is higher, it's almost a buy. Again, valuation is not a science, it's an art. All these assumptions have a tremendous impact on your valuation. Whether you want to be conservative or not is your decision. Me, I tend to be more conservative. Anyway, moving on to 10 cap. 10 cap is a very straightforward approach, which I like a lot. What it means is you look at the owner earnings. It's a fancy way of saying what is the cold hard cash you generate from the business. You have the GAAP net income. GAAP, if you don't know what that means, stands for generally accepted accounting principle. So with net income, you have to do a bunch of adjustments to get to the cash because a lot of things are accounting driven, like depreciation and amortization, which means a huge capital project. You don't expense that right away. You capitalize it, or in other words, you depreciate it over time. So you have to add that back because it's not real cash out of the door. And then the other items have a similar idea to it. For example, the maintenance capital expenditure, even though it's not expensed right away, it's cash out of the door right away. So you subtract that. It's a negative number. After we do these adjustments, it shows that owner earnings for the whole company is about $21 billion. So 10 cap basically means you buy at a price that's 10 times that. So think about investing in real estate. If you buy a property for $100,000, and you get $10,000 of cash flow after all your expenses like property management, mortgage, insurance, tax, etc. You're left with $10,000. So that gives you a 10% capitalization rate because $10,000 divided by $100,000 is 10%. So similarly, if you look at the whole company, $21 billion of owner earnings means you can buy the company at $214 billion. In other words, this is their market cap. Or it should be their market cap if you think you can buy it at a 10 cap return. And we divide that 10 cap price by the shares outstanding to get to the per share price. It's only $86, which is way below the current price. In other words, it is overvalued because their market cap is over $1 trillion now, which is crazy. And the third method is the payback time. This one is very similar to 10 cap in that you're looking at the cash generated from the business. The idea is that when you invest in a public company, typically speaking, you have 16 years before you can get your money back. Public companies are very liquid. It's so easy to transact. We as value investors prefer to leave the money in the company. We're not subject to the short-term emotions of the markets, as Benjamin Graham, Warren Buffett's teacher, would say. So the idea is that we only buy a company if it almost acts like a private company. So we expect to get our money back in 8 years instead of 16 years. So we look at the cash and we make a few more adjustments. So in this case, I saw in their 10K or Seeking Alpha that there were some other cash outlay in terms of their investment in marketable and equity security and some, I want to say, capital related cash outlay. So it reduces their cash a bit further. So it's $15 billion of free cash flow they generated in the most recent year. And the idea is that you grow that cash flow year over year. Interestingly, Seeking Alpha has a cash flow growth rate, which is very high. But to be conservative, I use the growth rate, which is the return on equity growth rate, to be conservative. The idea is that you grow this cash over 8 years. At the end of the 8 years, your cumulative free cash flow is $265 billion. You divide that by the shares outstanding, and then this is your per share price. It's $106. Like I said, though, if you look at Seeking Alpha, they're projecting all kinds of growth rates. And in particular, the free cash flow growth rate is 74%. So if we use that, it's unbelievable. If we think that this kind of growth rate can sustain at the end of the 8th year, they will have almost $3 trillion of cash. And then, of course, if you translate that to a per share price, it's over 1,000. Can they sustain this 74% growth rate? We'll see. All right, last but not least, margin of safety. This one is also pretty straightforward. We had the growth rate from the previous method, and then we come up with a PE ratio, which is 2 times that. Why? It's a shortcut because usually growth companies have higher PE ratio. So whatever the growth rate is, 2 times that is the windage PE ratio. And then historically, their highest PE ratio is 144. This company has not been overvalued for a long time, I would say. So it's not as high as some of the other companies that you would see in the tech space. Anyway, you pick the lower of the two. So in this case, 34. And then earnings per share, we had that from the previous methods. So in this method, we project their future earnings per share by using this windage growth rate. So in 10 years, we forecast the future value of the earnings per share would be $8.49. With the assumption of the future PE ratio, we get to a future stock price. So it's very simple. The future PE ratio, we said it's 34. The future earnings, $8. You multiply these two, you get to $291. And then you discount it back to the present value using 15% as the expected return. Why 15%? Because in the last step, we divide it by 2. That's how we make it more conservative. So this method actually gives the lowest stock price. And I think the main reason is the PE ratio is super conservative. And then the earnings per share, I used the end of 2023, which is even lower than what their 12-month trailing average is. But even if we change this earnings per share to the latest, it looks a little better. But the price is still only $83, which you would feel comfortable, super comfortable to buy. Obviously, that's way lower than the $476. So still a sell, unfortunately. All right, that's it, my friends. Hope you find this video helpful. Do you think Nvidia is overpriced? Whether or not you think that's the case, feel free to leave a comment down below. Let me know your thoughts. Thank you so much for watching. Until next time.